Welcome back, everybody. Today we're going to look at the Federal Reserve System and discuss its role in conducting what's known as monetary policy. So our goal is to have an understanding of the structure of the Federal Reserve as well as some of the tools at its disposal. So the Federal Reserve System is made up of three parts. One is the Board of Governors. The second is the Reserve Banks, of which there are 12. And finally, what's known as the Federal Open Market Committee, or FOMC. The purpose of these elements is to help support the banking system and ensure its stability and its long-term health. And the Federal Reserve's primary duty is to influence interest rates so that they can sort of control how the economy is doing. The Federal Reserve itself has two priority goals set by Congress. One is to have stable prices, and the goal of the Federal Reserve is to have inflation rates at about 2% increase every year. The second goal of the Federal Reserve is to maintain what's known as full employment. So the goal is really for the Federal Reserve to steer the economy through interest rates to long-run economic equilibrium. The way it does it, its job is to sort of follow through a process. They evaluate the state of the economy and determine whether the economy is at a place they want it to be or do they need to influence its direction. The FOMC then will set a target interest rate. That interest rate is designed to influence borrowing and spending within the economy. So they'll either raise it or lower it or hold it steady depending on which direction they want aggregate demand to go. Those rates will affect the cost of borrowing, which then influences the willingness of people to borrow money. Their decision to borrow or not borrow has an impact on the economic activity and overall GDP of the economy. And so as the Federal Reserve's policy changes are filtered through the economy, they'll then evaluate the state of the economy and see if more changes are necessary or whether it's time to stop and let the economy sort of move along until there's a need for change. There are basically two frameworks under which the Federal Reserve can operate. The first, which is the framework they used for a very long time up until 2008, is known as the Limited Reserve Framework. This utilizes sort of traditional tools of monetary policy, and we'll talk more about that in another conversation. And now the current system is what we call ample reserves, or the ample reserve framework. Here, traditional tools are not as useful. In this situation, the Fed just simply dictates interest rates. And we'll talk more about ample reserves a little later. For right now, let's look at what those traditional tools of monetary policy were. One is open market operations, which we're going to talk about in just a moment, as well as changing the discount rate and the reserve requirement. And we'll get into more detail about each one of those in just a minute. When it comes to open market operations, what we're talking about here is the Federal Reserve's either purchase or sale of government securities or government bonds. We sometimes call them T-bills. And what that is the federal government issues debt in order to pay its bills. And so the federal government needs to borrow money, so they'll go to commercial banks and they will give this thing called a treasury security to the bank. It's a promise of payment, and the commercial bank will give the government money. And that piece of paper basically says that the federal government will pay interest on the money they've borrowed for a certain number of years, and at the end of those years, they will pay back the principal as well, the amount of money they actually borrowed. And so this piece of paper, this treasury security, has value because it's guaranteed income from the federal government. And so you can either buy or sell these pieces of paper depending on whether you're willing to wait over a long period of time to receive your interest payments, or if you just need cash right now, then maybe you want to sell it to somebody. So these government bonds are bought and sold by the Federal Reserve in coordination with the commercial banks in order to influence the amount of money in the money supply. Their decision to buy or sell government bonds has an impact on interest rates, at least in what's known as the limited reserve system. And so, as we'll see, if we increase the money supply, it will cause interest rates to drop, And because interest rates are lower, it's cheaper to borrow, which leads to more aggregate demand, which is going to cause output to increase and GDP to rise. And if you wanted to shrink the money supply, then it would work in the opposite direction. So how does the Federal Reserve's decision to buy or sell government securities influence the money supply? That's sort of the real challenge in AP macroeconomics, is to sort of think through that process. So to help us, I want to start by putting ourselves in a context that we may be familiar with, and that's as consumers, right? We've all bought or sold something in the past. So let's think about this in terms of a business. So let's pretend that we're Chipotle, and Chipotle sells burritos to consumers. And when Chipotle sells burritos to consumers, they're going to send the burrito to the consumer, and in exchange, that person is going to hand Chipotle cash. So money's coming into Chipotle when they sell burritos. So understanding that from the perspective of the business, selling means giving the product to a consumer and taking money from them. And then on the flip side, if Chipotle needs to buy ingredients, they will send money to farmers, and farmers will then send back the ingredients to Chipotle. So when Chipotle buys things, money is flowing out of Chipotle and into the hands of consumers and farmers. If we were to then replace the word Chipotle with Federal Reserve, then we hopefully will be able to see what happens to money supply when the Fed either buys or sells Treasury securities. So when Chipotle bought ingredients, they were giving money to the farmers and taking the ingredients in exchange. In the same way, when the Federal Reserve buys Treasury securities, they will transfer the Treasury securities from commercial banks to the Federal Reserve, and in exchange give those banks money. And so the Treasury securities are transferred to the Fed, and money is transferred from the Fed to the banking system. There's now more money in the banking system, more money can be lent, which means that the money supply has increased. And if the Federal Reserve were to sell Treasury securities, then just like when Chipotle sells burritos, they send the Treasury security to the bank, and in exchange they take money from the bank. And so as the Fed sells its treasuries to commercial banks, it is taking money out of the banking system and putting it into the Federal Reserve. And as I said, money at the Fed is dead. Money at the Fed is not part of the banking system anymore. It is not being lent anymore. And so the money supply will begin to shrink. Another traditional tool that the Federal Reserve had at its disposal was the reserve requirement. They used to require that banks kept a certain percentage of all deposits on the bank premises at all times in order to provide liquidity to depositors who wanted to withdraw some of their money from time to time. The higher the reserve requirement, the more money the banks had to hold within their vaults, and the less money they could lend. So the higher the reserve requirement, the less money supply could grow. And so that was one way that the Federal Reserve could sort of keep the money supply under control. It's not really an important factor in today's monetary policy, however, because the reserve requirement is zero. But when it was above zero, banks had to meet this requirement, and if they didn't have enough money on hand, they would have to go and borrow money from other banks. They would enter into what's known as the federal funds market, and they would borrow money from other banks and pay an interest rate known as the federal funds rate. And if they could not find another bank to give them a loan that would help their reserves reach the minimum requirement, then they were forced to go to the Federal Reserve in order to meet this required level of reserves. When they went to the Fed, they would go to what's known as the discount window. Now, the Federal Reserve wants to be the lender of last resort. They don't want to have to meet all of the reserve requirements for all the local banks at once. And so they will try and incentivize the banks to borrow from each other first in the federal funds market by charging a higher interest rate than the federal funds rate. That higher interest rate was known as the discount rate. It was always about 1% above the federal funds rate. And if the Fed wanted to decrease money supply. If they wanted to have banks lending less, they would make it more expensive to borrow from the Fed. If they failed to have reserve requirements, they would raise that discount rate. And if they wanted banks to lend out more and increase the money supply, they could always lower their discount rate. These three tools sort of make up what monetary policy looked like under what's known as a limited reserve system. And we'll get into more detail about limited reserves next time.